Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, April 21st, 2022. It is 2:30 p.m. as I'm starting the video, so I'll get this one out well in advance before the close today. Just wanted to let's talk markets in a few sectors, but let's mainly focus on the markets here. All right, so lately I've been focused a lot on, as I usually am, always keep an eye on the 60-minute charts, one of my favorite time frames. I've spoken to the longer term charts quite a bit lately, including as of yesterday, so I'm not going to get there. Nothing's changed. My outlook remains bearish. I still have additional downside targets that are well below current levels on the major indexes. But we need to, of course, take out the recent lows, and not just that, it's level by level. That's the way things work. If you're bullish, or if the market's going to go up, it's got to take out resistance. So let's just keep it real simple here. Here's that 60-minute chart. I gave you a couple levels the other day, 335.22 on QQQ. To me, a big level. Why a big level? Well, we've had a lot of reactions going all the way back here to January. Major reaction low right there. We bounced there again and then took it out and had a big swoon down, followed by a fast recovery. So that's still significant to me. The fact you broke it, had a lot of selling, but then the buyers came in and reversed it. But then look, you danced on it again. There's probably, if you zoomed in tight, that's over half a dozen consecutive 60-minute candles testing the level. And when it broke, we didn't just kind of limp around. We went straight down again. Perfect back test. Another perfect back test. Ran down, put in a divergent low, double bottom. So these are the big levels right here. To me, you have, of course, the recent lows. That was a double bottom low in the NASDAQ 100. That's about 318 right there. And then, of course, this one here, as I just mentioned, lots of reactions there. That was also right after the breakout. Remember, we had this bullish falling wedge, a downtrend line on the 60-minute chart of QQQ, ramped up there, and we faded all of that, so we've come back to that level. So here it is. So when you zoom in real tight, this is the level we've been trading, bouncing between these yellow lines. Those are the most significant levels. This is resistance about 347.50 right here. You can see just for the last couple weeks, we're playing ping pong between that level, support and resistance, and we're back down to it right now. So, an active trader could try to game another bounce off that level, but you do have to realize one thing to consider, I should say, is that the more you tap on a level, sooner or later you're going to break it. So we've already had 4 distinct upside taps, a couple on the bottom there. I've made it clear for the last, for a while now, I favor ultimately a downside resolution, downside break of that level, whether we get another bounce or not. So for swing traders, trend traders, I would sit tight. I can only tell you what I'm doing. You guys have to make your own decisions on what to trade. But that's it. So watch that level. If it breaks, there's not a whole lot of support. There is a gap right here. Active traders look for gaps and reaction highs and lows. So there's a gap to be backfilled there. But if that happens, we have a solid break there. We're probably going to run at, and if we run at, I think we'll take out those lows. We've already had a double bottom low there, and we put in positive divergence. So I've said this a lot. I often talk about, in parentheses, what should happen. In other words, and we're in a bull market. The primary trend's still bullish. Every other time we've had a big, multi-week, multi-month divergence, a big divergent low on the 60-minute chart, that has been the catalyst for a move to new highs. So what will happen is, if, as I suspect, that divergent low only plays out for that relatively small move. Relative is relative to the big picture. You zoom back, relatively speaking. Again, if it should been the catalyst to new highs and it proves not to be, then it shows a shift in the supply-demand characteristics of the market, meaning there's not as many buyers as there have been for the last few years that gobbled up these divergent lows and then continued to buy after the breakout. So that's it. Again, I'll tell you what I think is going to happen, but most importantly is what does happen. So if they buy it here and they go up here to the top of the range and they ultimately break out of 347.50, I've given you some other levels, and I still will, and you can see them right there, 357.15, probably the next key resistance. I have minor levels here as well. And that's the level, again, that I really would change things for me if 370 and change, 371 is taken out, because we'll also have taken out the 200-day moving averages after the second distinct failure there, and I'm not talking one day. I'm talking clusters. This was we're on a 60-minute chart, but if I had a daily chart up, you'd see that's also where we failed the 200-day moving average, and that's it. So very near-term micro stuff. Near-term bulls win if they take that level out. Bears win if they take this one out, and then we head down there. And like I said, yeah, maybe another reaction off there. Maybe they put in a triple bottom. Anything's possible. But I think any reaction next time around, if we get close to that 318 level, will be short-lived. We could just go right down through it. But let's take it one day at a time. That's why I do these videos and these updates every day, because things do change. And most importantly, before I wrap up and move on to the SPY and some other charts, we still have positive divergence at this point in time. We had it here at this low. We had a little bullish falling wedge. It broke out, put in a marginal new low, which was a divergent low. The divergence still extends and would even on a marginal low. So we could have a breakdown of 335.22. On face value, it'll be bearish and will be bearish unless it's reversed. So if you're bullish or if you're short and you short that breakdown, you see a solid recovery back above there, and the divergences down here are still intact, that could be the catalyst for another move up to maybe take out run at again. And probably at this point, if we run at 347.50 again after so many clean tags, would probably pop it, would be my guess. So I'm just telling you what's likely to happen if it does happen. Okay, so again, not my preferred scenario, but one that I would certainly recognize and play as such if that does happen. What does that mean? It depends on active trading or swing trading account positions, to reverse out of shorts into longs possibly, or again, all depends on one's time frame and trading style versus being an active trader or a less active swing trader that holds positions for several weeks, several months, trend trader that holds positions for months or even years. They're all going to have different this will mean different things to them, or it'll mean nothing to them. Long-term trend trader might only trade off the weekly and daily charts. There's a weekly right there. All right, let me show you a few other levels, things to watch. This is the SPY S&P 500, and that's that level I gave you the other day. So you can see SPY, although QQQ is at that yellow line now, SPY's been stronger, holding up more so. This continues to be, largely a tech induced. There's a lot of sectors holding up, sectors that you don't even have in the NASDAQ 100, such as financials. So, for the market to break, the S&P 500, majority of the sectors have to break. I do think it'll happen, but again, this is the level where those odds are going to go pretty high that we're going to go down and make a run at those lows. There's the lows on a S&P 500 back here, and that's quite a ways below. I don't know why I have a random line there. I'm going to lower that line right there. And so that's what you're looking at on SPY. I'll give you one other level if that yellow line goes. It's going to be right here. There's that gap right there that I showed you a minute ago on QQQ. Comparable gap right there. There's your gap. So that you have gap support, top and bottom of the gap, but it's minor. Again, we break this yellow line, I think it's going to bring in some selling. What caused the reversal today was, first of all, it was technically induced. You can see you have resistance. It never fails to amaze me that the news headlines align with the chart. So actually, we had the reversal first, then Powell's comments came out. Powell's, the headlines from the Journal. Powell seals expectations of a half-point rate rise in May. That was already baked in the cake, to the best of my knowledge. Funny how the market reacts to it when it was it's old news. I guess just that he made it official. But I believe the Fed funds rate had clearly priced in a 50 basis point hike. Either way, it's rejection. That's a big resistance level. So see, this technical analysis, and especially in periods of high volatility, works, and it works well. There was your breakout. It was about the measured target. There's the widest point of that wedge pattern, and that's about what you hit. And now we're reversing, and we still have, at this point in time, if we fell real soon, we could keep that divergence intact. But what I'm continue to look for, I want to see this divergence taken out. and then that's going to tell me we head down here, and this again is to me a change of character. A change of character I believe will happen, but it needs to happen to kind of help me firm up the bearish case. And what I mean by that again is the fact this 60-minute positive divergence, failed to take to propel the S&P 500 above the recent highs right there, as well as the all-time highs, because again that's been the MO for years now in this stimulus-induced environment. And, Powell's comments were pretty stern. He talked about kind of if I remember, just glanced the headlines and glanced the article about being or speaking to the benefits of maybe front-end loading the reduction of stimulus. So, translation there, pretty aggressive hikes up front. Said look for 50 basis point hike, and more of those probably to follow would be justified. So you could have a series of 50 basis point hikes instead of 50 and then a quarter, and also maybe more aggressive reduction of the bond purchases, their portfolio there. But all right, so those are levels. Let's not beat a dead horse. I want to give you the Nasdaq 100 for you NQ traders. Nope, that's NG. Here it is, NQ. In the same levels, you can see, I'm going to zoom in a little tighter for you NQ traders, and you can just see it's in a perfect, that's a great level of resistance, 14,294 right there on NQ. It was support right here for a while. It was support there, support, reaction. We broke it, back tested it right there, went down, came up, back tested it and rejected again, came up, back tested, rejected again, came up. I mean, that doesn't get much better than that on the 60-minute chart. And so that was again an objective short entry. Would have been bullish if the bulls could have popped it, but guess what? They didn't. Not only that, there were a lot of sellers waiting in the shadows, lurking in the shadows, waiting to step in there, and they did. Longs exiting their positions, and or short sellers stepping in. And now you need to take out the, this was really right here, this is important support, and we have taken it out, 13,866 roughly. You also had a downtrend line right here. This was a divergent low. Well, that divergent low should be right there. And you can see we had a breakout after the divergent low. Back tested it a couple times. We're back testing again. So again, this is where, quote unquote, the bulls should step in. If they don't step in, why not? That's a nice another back test line. You have support just above there, and then support there. So if they do this, it just shows us markets, at least right now, that the sellers are in control, and there's more selling than buying in the market. So those are levels to watch. Let's talk about small caps real quick, and then I'm going to talk on a few individual stocks and earnings, and we'll wrap this video up. Small caps, I continue to reiterate, I think it's a great, objective shorting op, has been for a while. IWM has a lot of potential. My first target was hit way back here. That was after the sell signal we broke. This is a weekly chart I'm on. We had, I got these lines all. We had that multi-year, over a year long, or about a year long trading range there, the breakdown, back tests, numerous back tests, which were all shorting ops. You had opportunities to cover at that first target on several occasions. It was support, and it still is support until it's taken out on a weekly basis. We haven't yet to do that. We've only had a few intra-week dips below, and that's it. Simple stuff, really, if you look at it that way. There's a trend line there, downtrend line, which we also broke above, but there was no follow through. This was a brick wall, in my opinion. Was and still is. And these are the things that start to, change my view if taken out. If the bulls can ramp right up through 209 and clearly take that level back, take back the 200 days, hey, that's bullish. There's no other way to spin that. If 192 is taken out with conviction, especially a weekly close, no way to spin that but bearish. And I would say the odds shoot up significantly that my next target, T2 down here at 171, will be hit. And that would be from where we're at today. That's another 13, almost 14% downside in the Nasdaq 100. And then I have a potential third and fourth target. We'll see how things go. Alrighty, let's talk sectors real quick, and then I'll go to individual stocks. I'll wrap it up there. Some of the big market-leading things that are due to report. So in the last couple weeks to months, I've focused on a few sectors I told you are some of my favorites. for swing short and trend short positions. One of those is IAI, that's the U.S. broker dealers index fund. So these are your, everyone listening to my voice has skin in this game. These are your broker dealers, Schwab, Interactive Brokers, and they also have the indices in there like the NASDAQ and things like that. NASDAQ's in there, and so you kind of gives me an idea of the health of the financial markets. And this is a big level to me on the weekly chart here, about $97. You can see that support level. We had a breakout right here. Let me zoom in real quick, show you how I analyze these charts. Yeah, rallied up to it. This was, I believe, an all-time high there. Pulled back. Finally, a breakout. We tested it for several weeks. Went up, tested it again for several weeks, couple months. Held that support. Off to the races, new highs, but those not paying attention, weren't looking at the big divergences forming. We put a negative divergence, and then boom, another back test. Usually when you break out, that's it. And then you go. To come back in and continue to back test, not so healthy. Now, with that being said, as I often do say, support is support until unless broken. It's not broken yet. So if you are bullish, you step in and buy, or you wait. Maybe there's a downtrend line you can buy there. You can buy support all day long with a stop somewhat below. I am, based on the posture of the charts and everything else, I think the support level is going to go. We're below the 200-day moving averages. We're coming off a big divergent high, and I don't have a whole lot of support. There'll be some zigs and zags along the way. I could put an initial target there about 87.30, but ultimately I think we come on down here to this level about $70 or so, and if so, that's going to be a drop in the broker dealer index of about 27%. And actually, I take that back. That's my initial trend or swing target. I think we'll bounce there and then work our way down and come into this long-term primary bull market uptrend line. And if that happens, that's a drop in that sector of about, depending on if and when we get there, of course. The if means, or the when part means, when you hit it, trend lines come in higher and higher levels every day. If it took a while to get there, it might be only about a 40-something% drop. If it happened, over the next 11 months or a year or so, it'd be about close to a 50% drop. And let me put a price line right here. I'd see some price support as I was holding the crosshairs there. So that would be it, about $60. And here's where I'm going with this. So if let's say that happens, we get about a chopped in half, this sector, 45-50% drop over the next year, 1.2 years where I'm holding the line. If it's it then year, call it a year and a half if you want. Guess what? That's just simply a bull market correction. And you might say that's crazy. That's sector gets cut in half, because you're still only coming back to your long-term primary bull market uptrend line. So I don't think my targets are very aggressive, especially considering the macro picture right now. The Fed finally, after took him forever and a day to pivot, and Powell I'm talking about, and even after he pivoted, being completely dismissive of inflation, referring to it as transitory, he pivoted, but he only pivoted in rhetoric, and he's finally now come full circle where it's action. We've already seen the first rate hike, and we are going to see more of those, and so they're taking the heroin away from the patient. So anyways, that's a sector if you want to tuck it away. And if you look at the daily chart, again, you got to take out the recent lows here. We've had a few intra-week breaks there, but you want to see a solid break. And at this point in time, probably break below 95 will do the trick. Heck, I think you can short it now. I'll just say that. Usually I don't make a habit of shorting at support, but I don't. I see the odds of this breaking down much higher than the odds of it holding. I think a breakdown is imminent. All right, let me give you a few other sectors. Again, these are all things I've covered recently. Home builders, that one's already clearly in a downtrend off the highs, about 32%. Latest numbers came in this week. Home prices at the all-time high. Existing home sales. But yet, look what the home builders are doing. That's, again, existing home sales. Home prices are up, but the builders are already, clearly in a downtrend, and probably more to go. There is some positive divergence, so I'm cooling off at this point in time. In other words, another way to say it, I'd rather short the if I didn't have anything, short um, the broker dealers before the home builders right now. They'll probably burn through this divergence. Again, that's a signature of a bear market, that positive divergence either doesn't play out at all or only plays out for a small rally and then a resumption of the downtrend. So I still maintain this next target down here, whether we bounce first or not. If we do bounce first, I tell you right now, about right here-ish, about 66 would be my max bounce target. You got the moving averages coming in. You have price. This was all support back here. We broke it, back tested, and that would be an objective level to short or add on if we get there. And again, we may not even get there. That's what a bear market, if we are still in what I believe to be the early stages of a bear market, then that's the nature of it. It doesn't make it easy for the longs to get out. All those that say, oh man, I've been holding these, I'm just going to wait till we bounce back to that resistance. And it doesn't want to let the shorts in. Again, that's just the nature of it from my experience. SOXX. Semis are still like that. Let's look at the weekly chart and show you that, because that's where I give you long-term targets a couple weeks or a couple months back. T1 still maintaining this first target zone. That's around, what are those numbers at? About 385 or so. You had the, you're below the key 40-week, 200-day moving averages. You broke this trend line here. You put in that big old divergent high right here on the weekly, and we've been walking our way lower. Yet there's all this demand for semis. There's still, I had to this morning drop my wife off to take her car in the dealership. The lot was empty. I mean, completely empty. That's still the case. They have the chip shortages. Yet why are these stocks, the semis, going down? And I'm going to talk on that in a minute. We have some earnings coming up. So it just shows that that's not a good sign. In other words, yeah, this was the run right here from COVID. Here's the sector it priced in, all that demand, all the profitability from the chip company, but 234% run. And again, by this look at this chart, that run is over. And even though we've already come off the highs by about 25%, so the sector's been chopped in in fourth and a quarter. But we still have to my target down here. First target is about another 8% below, and then my final target is about 35% below. So plenty of meat on the bone. And like that other sector, the broker dealers I showed you, all that does, as aggressive as my target might seem to some, it's just a correction within a bull market. I don't view, my definition of a bear market's not the same as everyone else's. It's not a 20%, the old school definition. The semis move 20% in a matter of weeks sometimes. They're just some more, the rips and dips, the trends are a lot higher. And these are all corrections in a bull market. 28%, 27, 39 that I've highlighted here. And you can see I labeled them bull market corrections. So this would be a bull market correction, but it would be, by most metrics, most people consider it a bear market. Again, it's semantics. You want to consider it a cyclical bear market within a secular bull market. That's what you can do. But you're talking a 50% drop. And so those loaded up with a lot of semiconductor stocks that are feeling the pain with down 25% from where they were a few months ago. Well, if I'm right, they've got another 35% more pain coming from this point, and at that point they're going to be down half of what they had in their semis if they ride that out. And if I'm wrong, here's the thing. Let's talk about being wrong. Maybe I don't do that enough. If I'm wrong, then that's it. Depending on where you shorted, you had a breakdown here. You're not going to hold out for a 100% loss if it does this. You're going to be stopped out anywhere, depending on where you shorted, probably not much higher than that recent high at most, and in many cases a lot tighter. That's where you zoom down to the daily charts and you look at resistance levels and other things like that. And here's another sector, like so many, with positive divergence. So again, the ball is in the bulls' court right now. They can take this and run. You have divergences in so many sectors, including the NASDAQ 100 and everything. Beautiful divergences. And again, this is going to be a change of character if these divergences play. Look, we had divergence right here at this point, right? There it was. And we rallied, right? We had a decent rally, but guess what? It failed to take out the previous highs because this is a brick wall, just like on IWM and SPY and QQQ. It's these recent topping patterns here. The bottom of that pattern is well defined in just about every index that I track and cover, as well as a lot of the sectors like this. And that's what happened. We got rejected there. So that to me looks like a bull market top. And now you have big support here. And if we crack it and head down soon, these divergences get taken out, and that is a signature of a bear market right there, seeing such beautiful big positive divergences. When was the last time we had a big divergent low? Not even, yeah, about as big right here, and that divergent low was in a bull market, and before all said and done, we rallied 290% in the semiconductors. So if you're a bull, well, this is your first divergent low that I see on SOX since the semiconductor sector ETF since back in late 2018. So there's your opportunity. But if you're a bear, you have an opportunity to make another. I guess I would have highlighted back here on the breakdown and back tests. Actually, back here I think was before that. If you hold out and the target's hit, you're going to be. That's another 50% or so drop. And I gave you, of course, this one is a trading proxy for it, SOXX. All my lines got moved because it did a reverse split. I had given you targets before. I'll have to replicate this. This trading platform, unfortunately, does not make an adjustment for the 1 to 10 split, reverse split we had there. Alrighty, now let's wrap this video up with earnings coming out next week. Okay, so let's just talk real quick. To do that, let's talk about this one first. Let's just talk in the order things, because what I'm seeing is market leaders one after another getting taken out, tied to the post, and shot by the firing squad. First one was Facebook. This is one of the big fangs, top components of the NASDAQ 100, S&P 500 put in. I know there's a lot of lines on this chart, but the ones that are most important here are these. This is your divergence line. Negative divergence here on the weekly time frame. There was a cleanup trend line, formed a big bearish rising wedge on the weekly chart. BRW we'll call that. There was a breakdown, went back test, did like a lot of things. See, it bounced around in a trading range here, and that was several months, and then boom, broke it. I think that was earnings induced break, shot down, bear flagging action right here on the weekly, and already going down again. And so that's one. Look, this thing can bottom now and go up. It doesn't matter. The damage, it's already done a 50% drop. Again, one of the largest companies in the world, highest weighted components, and that that one's already boom. Okay, taken out. Netflix used to be up there, but I commented on this way back when I started calling them the FAANGs, FAAMG. They even wrote an article on that, picked up on my comments there, because Netflix wasn't moving the needle. It was not as big a company as it was market cap, but it is still a crowd favorite, and it is still a very large company market cap wise. It's just not as big as Amazon and Apple and Microsoft. But there's another one just taken out to the woodshed here. You had several uptrend lines, but your primary uptrend line there, like everything else, big divergences, just like we have on the indexes. And sometimes, and often, those divergences, especially on these weekly charts, can build for months or even years. But when they finally play out, it's ugly. And so there's another one, boom, taken out, tied up to the fence post, put a cigarette in its mouth, and executed. That stock's dead. I mean, it's not dead, gone forever. There's big support here. I told you I scooped a little more today just to hedge. I have a lot of index shorts. I think it might be dead money for a while. It's still a little bit above that support. I'll scale in down to about 200, give it a little room. Maybe dead money, especially if the market drops and it's going to come under forced selling pressure. So it's not a hard buy by any means. It's just down here support. I still think it's probably going to close within the next week or two up to this 235 level, unless the market breaks. Because if the market breaks, remember, you're going to get forced selling. So I wouldn't put a lot in there. But I just want to show you these market leaders one after another. And now what hasn't broken yet, and this is when the market dies, is the leaders. Apple. Okay, cream of the crop, biggest company in the world, $2.7 trillion market cap. What does the chart look like? Well, big negative. Same thing like Netflix and all the others, Facebook. You have these big divergent highs, and everybody. Well, Apple's different. Apple, everybody's got an iPhone, and they're just their app store, and they're just a earnings juggernaut and profitability. But I point this out all the time. This is a chart since the last bull market started. To me, the last bull market started in March of '09, right here. It doesn't look like much, but that's when the bull market started. And I've circled this. I've circled every single divergent high that we've had on the weekly chart and all the corrections. In these bull market corrections, the last bear market resulted in a 62% drop in Apple. The bull market corrections, 26, 15, 16, 45, 32, 34, 39, 35, 21, and you can see now the divergence that we have in place. This almost over a year long divergence is comparable to this one that gave us a 39% drop, bigger than this one that resulted in a 45% drop. And as aggressive as it might be, this is my bear market target for Apple, all the way down here to $90. And what do we need to do? We got to break down. Like those other ones, the divergences will continue to build, the stock will continue to go up until it breaks. And when it breaks this trend line, that's most likely the catalyst, and therefore Apple's probably going to get cut in half, 50%. Certainly stops along the way. Okay, so they report on Thursday after the market closes. And why I wanted to talk on this too is, okay, let's say you're a hedge fund manager. Bill Ackman just got his clock cleaned on Netflix. You might have read about that. He had a large position and he just exited it and finally gave up. He had been buying it, bought heavy back earlier this year. So let's say you're either an individual investor or a hedge fund manager, and then this is nagging at you right now. This is what you're thinking. Wow. Last time I went into earnings and I had Facebook, boom, I got wiped out. And in just a matter of a couple weeks, it fell 35%. Okay, that was a one-offer, right? Well, guess what? Oh, Netflix too. These stocks are getting clobbered on earnings, and all of a sudden, the revisions, forecasts change, expectations change. Never, ever underestimate the power of a crowded rush for the exits. And in history, we haven't seen such a crowded theater as we have now with this uber low money and stimulus, the over excessive stimulus the Fed and federal government have thrown at the economy and the stock market, and it's being unwound, and now it's being unwound at an accelerating rate. So if I make no promises to whether any of my analysis or trade ideas are going to be all right. But the one thing I just want to impress upon, especially if you're new to this, is again, don't underestimate how far once the dam breaks. I was warning of a few weeks back. We had those what I called the market watch or crash watch. I put it a crash warning, and then I moved it back in recent weeks when we broke out of those 60-minute wedges to more of a watch, which is not as imminent. The risks aren't as high, but we're getting close. The closer we get to those recent lows, we're going back to a crash watch where boom, you can see this unwinding and you can see it in the market. And again, it's going to be when those other leaders break, so we're going back to that. So there's Apple. Apple's fine technically now, but not the posture. It looks to me it's imminent. It's a matter of time before we break the 200-day, the 40-week moving averages and this support level. These are key support levels here. Again, that would be the catalyst for Apple. And so my point was, next week, as we get closer to these, how many nervous hedge fund managers and individual investors, imagine those mom and pops or whoever owned Apple for a long time, and then they're seeing these stocks like Netflix and Facebook getting taken out, taken to the woodshed over, earnings reports that the street doesn't like. So there's Apple. Let me just go with the other ones. Microsoft starts it out on Tuesday after the bell. Microsoft, I'm on a weekly chart again here, right on trendline support, already taking out the 200-day moving averages. Again, on a weekly chart, it's a 40-week same thing as a 200-day, and we took them out. We've been back testing just like the stock market. We had multiple failures, 3 weeks in a row right there at the 200-day slash 40-week moving average, where Microsoft, just like the S&P 500 and Nasdaq 100, tried to regain after breaking. We've traded below. We took out the 200s back here. We've remained below, rejected, and now all we have to do is take out those lows. Boom. They report Tuesday. Look, if I was a long side only, which most mutual funds and a lot of hedge funds are, fund manager, pension funds, I would be thinking about taking some off the table. Microsoft, like everything, has had a hell of a run since when COVID hit back here. You turn all the lines off. Let's just say they held on and didn't get shaken out. Then it's up 163%, still well off those highs. It'd be prudent to take some off the table. So that's what I think we're looking at over the next week or so. I think we'll see some selling in anticipation of those earnings coming up and people not wanting to get caught, because this is not yesteryear's market. This market is now taking stocks that miss earnings expectations or give anything but a glowing rosy forecast. They're getting taken out to the shed. So that's Microsoft Tuesday. Also, Alphabet, Google's parent company, reports on Tuesday. I've got it at a big key support level here, about 2,500. That's like so many stocks, this multi-month, year-long topping range there. And boom, if that breaks, that's going to be a powerful sell signal. They are on Tuesday after the bell. And then you have Facebook. Look, Facebook, I don't know how much more downside. I do know this is similar, or appears to be a bear flag pattern on the weekly chart. So we could see a lot more down in Facebook. But, I wouldn't be looking to short stocks that have already dropped, especially former market leaders, or still market leaders, that have dropped 50%. Better fish to fry. But again, anything's possible. It could go down quite a bit more. I don't think, the bottom's not in that one. But they do report Wednesday, along with PayPal after the bell. PayPal, here's one that long since topped. Again, this is what I'm seeing, one after another. These are the top components, by the way, guys, of the Nasdaq 100 and many in the S&P 500. This one's down 70%. So, the stock market is in a bear market, and I've been saying that for a while. But it doesn't. Technically, the indexes aren't, if that makes sense to you, especially the Nasdaq 100. Why? It all comes back to weightings. QQQ is Apple is the biggest weighted component in the Nasdaq 100 and the S&P 500. I'm looking for my weightings. I have it written somewhere here on there. Sorry. Those top handful of stocks make up the majority. They have the highest weighting, and that's why the index itself is not too far off all-time highs in Nasdaq 100, but yet when you lift up the hood, the majority of stocks in there are well off their highs. Many of them have already exceeded well over 20% drops. All right, let me just wrap this up. Qualcomm, big semiconductor. Told you I'm bearish on the semis. Gave you some targets there. Do have a trend line I just noted here. We'll watch that trend line and some potential divergence right there. But from a long-term perspective, which is what I'm looking at now, weekly chart, big divergent high right there. And my next target on Qualcomm is 123 right there. And then if and when that breaks, which probably will, we head down to 94 and $95. That'd be about a 32% drop in Qualcomm. Alrighty. Ford also reports on Wednesday, by the way. Ford's already broken down the uptrend line there. And then Thursday, bringing it home for the week, last big fangs. Another one of the holdouts is Amazon. This is a weekly chart, and it looks a lot like many other sectors and indexes with this multi-year long topping pattern. This has been almost 2 years, over a year and a half of trading in this range. I just boxed in there with a few, just like the market, a few brief spikes below, but recovering it on a weekly closing basis. So that's it. There's the magic number. Let me just give it to you. About 2,900. And then I have a long-term trend line just below right there, the blue trend line, and then this one. So I'll color this one up. Here's your big level. I think this will be the nail in the coffin, I believe, for Amazon when we take out, it's about 22 2,700 or so, which is that yellow level, price level plus the trend line. And where does Amazon go before all said and done? If that happens, down here, 2043. I'd put good money on that. It's going to come within, within a close, very close, percentage range of that level. That's about a 31% drop from where we're at now. I already covered Apple. Apple, I told you, reports Thursday also, along with Amazon after the bell, and then Intel, INTC, the big semiconductor stock. And so this is on a weekly chart. Man, you almost have to go to a monthly chart. You turn off all the lines here, and you can see this is just a big, it appears to be a big topping pattern to me on Intel. Could be consolidation, who knows? You could certainly go up, but when I draw that trend line like that, we're below it. But either way, this is the key level is going to be here. These recent lows about 40. That's around $43 or so. If that's broken, that would be a major support level on Amazon. I'm sorry, Intel. And then this is really a double top high. That divergence is extended, so I should really just put DH4 there. Duplicate that and move it over here. DH4. Meaning, what I mean by DH1, 2, 3, 4, it's just when you have an extension of divergences that continue to persist. So we started diverging at this point. We had a little bearish rising wedge right there, and we had a breakdown. It's not as if that didn't work. That divergent high resulted in a hit my target. I had a target on that wedge break, 24% drop I was calling for, and we got, it was 26%. Then we went up, we hit that level again, also extended the divergence, and another drop down to that level, another 26 or so percent. But then the divergence continued, and an even bigger drop each time. See, there's the pattern. You can see each time we had negative divergence here, here, here. It all generated or began from that same point, those divergences. Each drop was bigger than the previous. And then we had another one there, same thing. Every time we get there, we come down to this point right here. That's the MO. Every time we put in a divergent high, the drop's been bigger and bigger, and it's taken us back to the same exact spot each and every time. So now that is, say what you want about it, where you think the stock's going. You cannot argue that is not a very significant, well-defined support level, and therefore if that level goes, that should be quite bearish and could take the stock a lot lower. But hey, if you're bullish, step in and buy there with a stop somewhat below. And you can even, this one's already, kind of slogged sideways for a while. It hasn't really gotten crazy high like a lot of others. So there's a trade idea for you. I just wouldn't, based on the posture of the markets, I would rather either sit this one out or wait to short it. But if you are bullish and you get a break of that level and it's just a brief breakdown, you have the potential to have some positive divergence here on the weekly chart. So that's Intel. Just wanted to mention again that they report on Thursday. So that's what to look for. A lot of big earnings next week. And although I cannot promise you which way any of these stocks are going to go before or after earnings, what I can tell you with a high degree of confidence, expect some volatility between now and then, as there's a lot of jockeying, position shuffling in front of and after those earnings. And then finally, don't read too much into what happens after hours when the earnings reports come out. You see that futures shoot up and down in pre-market. The stocks that report shoot up and down, and quite often the initial reaction is not the lasting reaction. Sometimes it is, but sometimes it isn't. So that's it. Just kind of maybe what I like to do in earnings season, just kind of an FYI, a tidbit, on swing positions that I have, whether it's index futures or ETFs or anything like that, or individual stocks, especially if I'm holding a stock going into earnings, sometimes I will either temporarily pull my stops after hours or widen them up a little bit. But I leave my profit targets in place, because the goal on any trade is to hit your profit target. So you get a lot of after hours noise during earnings season when there's a big earnings company, a big report that's moving the futures, and I call it noise because sometimes that's not the lasting reaction that sticks, and so therefore I don't want to have a stop on a position that's close to being stopped out, clipped. Now it's a double-edged sword. When you pull stops or widen them up, you are opening yourself up for the potential for a larger loss. But I also it goes in line with how confident I am at the time time on that position hitting its target, and also how profitable I am. You know, if I have a short trade that I've been, let's say I was shorting Intel from up here, and I'm very, very profitable, I can afford to have a much wider stop than if I shorted it today and I'm going to hold it into earnings on Thursday. At that point, I can incur a very big loss on the stock if it goes against me because I don't have any embedded gains. So hopefully that makes sense to you guys. Alrighty, let's wrap up here, and let me look at my list, make sure that's everything, which it is. That's what I wanted to cover in this video. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.